Welcome to 3 Lanes number 27. This one is kind of like a study guide for um, one of the classes I am taking, and it's uh, finance. Uh, what is it called? It's not managerial finance, financial accounting, sorry. Uh, and in this case, I have four different sources: Deloitte and McKinsey reports, and I put them on a NotebookLM file, and it created a podcast episode, which I'll publishing right now. So with any further ado, I am gonna leave you with Notebook LM hosts. Let me know what you think. I hope you enjoy it.
Okay, welcome to the deep dive. Today we're peeling back the layers on the dazzling world of fine jewelry and premium watches. We've got a really interesting stack of sources for this dive. Some crucial reports and sharp insights from McKinsey, Business of Fashion, and Deloitte.
Yeah, it's a fascinating sector, huge cultural weight, obviously, but also serious economic power. We're talking over $330 billion in annual global sales combined.
Wow.
But as these sources really hammer home, it's an industry that's seen some, well, pretty major disruption lately.
Absolutely. So our mission here is to unpack the most critical shifts happening right now, especially looking ahead to 2025 and, beyond.
Right.
And we really want to focus in on what these changes mean for specifically the supply chains, how these precious goods move, and the financial accounting, how the money flows and gets reported.
Exactly. This isn't just theoretical stuff. These trends have real, tangible impacts on how companies operate day to day and, crucially, how they report their financial health.
So think of this as your fast track, getting you informed quickly on the sort of intricate business mechanics underneath all the sparkle.
Let's get into it.
Okay, so let's start with the recent past. It wasn't exactly smooth sailing, was it? The pandemic really threw a wrench in things.
Oh, definitely. The sources point out fine jewelry saw revenues drop like 10 to 15%. Significant. But watches took an even bigger hit, down 25, maybe 30%. That really hurt.
And that impact wasn't just, people pulling back on spending. It exposed some existing weaknesses, didn't it?
It really did. A huge one was the reliance on physical stores. I mean, they just shut down overnight.
Right.
And let's be honest, these industries were lagging a bit digitally before all this. Jewelry was only about 13% online pre-pandemic. Watches, even less, a tiny 5%.
So they just weren't geared up for that sudden shift when the doors closed.
Not at all. And then you had travel basically grinding to a halt.
Oh yeah, travel retail, huge factor.
Massive. It accounted for something like 30% of their sales before COVID. Just vanished.
So that period, that decline and disruption, must have had immediate, pretty profound effects on the financial accounting side.
Absolutely. Companies suddenly had to look at asset impairment. The value of their stores, maybe inventory that just wasn't moving, values dropping on the balance sheets.
Right.
Inventory management became a nightmare, stock stuck in closed shops, warehouses overflowing maybe.
Yeah, messy.
And revenue streams just completely changed shape. It forced a total rethink of forecasting when those reliable, high-volume channels like travel retail just weren't there anymore.
So the financial statements from that time must really tell a story of sort of exposure to those specific risks.
Exactly. But looking ahead, the forecast is, well, brighter. There's an expected rebound, right?
There is, yeah. The sources are predicting growth through 2025. Fine jewelry globally expected maybe 3 to 4% annual growth. Watches a bit slower, but still positive, looking at 1 to 3% growth per year.
Okay, so recovery, but maybe at different speeds. Where's the main growth energy coming from then?
Two key areas, really. Younger consumers, that demographic is becoming super important. And also domestic markets. With international travel still maybe not fully back or just uncertain, people are spending more luxury money closer to home.
Right, that makes sense. And those domestic duty-free zones, particularly in China, they mentioned that's a big driver too.
Yeah, definitely. And Asia, it's already such a powerhouse for these industries.
Oh, absolutely. It's currently, 45% of global fine jewelry sales and 50% half for watches.
Wow.
And that share is only set to grow. Branded fine jewelry sales in Asia, forecast to surge by 10 to 14% annually, watches maybe up to 4% a year growth just in that region.
That kind of regional shift, that dominance, it has huge implications for supply chains, doesn't it?
Massive. You need incredibly robust logistics, distribution networks built specifically for those Asian markets. You're dealing with different import rules, last mile delivery challenges.
Yeah, completely different ballgame.
Precisely. And from that financial accounting angle, okay, projected growth lets you be more optimistic in forecasts, but where the sales happen really matters. Companies have to segment their revenue reporting properly by region. They need to understand the very different cost structures operating distribution hubs, retail stores in Asia versus Europe or the US. It affects tax, labor costs, marketing spend, everything.
Okay, let's zoom in a bit. Fine jewelry specifically. McKinsey and Bove highlight 3 big transformations there.
Right. The first one they call online magic, which sounds nice, but the challenge is huge.
Yeah.
How do you replicate that really personal, high-touch, often quite emotional experience of buying fine jewelry, but do it online, through a screen?
That's tough. It's not like buying groceries.
Yeah.
But the data shows people are getting more willing to buy jewelry online.
They definitely are. Online sales are projected to jump quite a bit from that 13% pre-pandemic up to maybe 18, even 21% by 2025.
So nearly doubling.
Pretty much. Which means brands have to invest seriously in their digital game. We're talking slick e-commerce platforms, amazing photos and videos, ways to connect emotionally, maybe video chats with stylists.
But the physical store isn't dead, right? The report still says, 80% of purchases will involve a store visit by 2025?
Correct. So it's not either. The real goal is true omnichannel, seamless connection.
Like discover online, try in store, buy wherever, get it shipped home.
Exactly that. There's a quote from Rahul Kadakia at Christie's saying online broadened their reach hugely demographics, geography, but making that digital experience feel luxurious, personal. That's the ongoing work.
Okay, thinking supply chain here. This isn't just building a nice website. This needs a whole different fulfillment setup, right?
Totally different. Instead of big shipments to a few retailers, you're now potentially sending single high-value items directly to thousands of individual customers all over the world.
That needs different warehousing, way more security, special packaging, different shipping partners.
Absolutely. And financially, the cost of fulfilling those direct online orders is way higher per item than wholesale.
Right.
Plus, you've got to manage online returns, which is tricky and expensive for luxury goods. And marketing spend shifts massively towards digital ads, online customer acquisition.
And revenue recognition changes too, presumably.
Yep. Now it's typically when the end customer gets the product, not when a retailer gets a bulk shipment. Small shift, but important for timing.
Got it. Okay, second big shift in fine jewelry.
This one's called buying into brands. So traditionally, a lot of the fine jewelry market was unbranded. You bought based on, the quality of the diamond, the gold weight.
Not necessarily the designer's name.
Exactly. That's changing fast. People increasingly want the brand.
So the brand name itself is becoming a key factor.
Very much so. The branded share of revenue was around 20%. It's forecast to jump to 25, maybe 30% by 2025.
Which is huge money-wise.
It translates to like $80 to $100 billion. And the growth rate for branded fine jewelry is predicted at 8 to 12% CGR compound annual growth rate.
Wow. Okay, so
That's roughly 2 to 3 times faster than the overall jewelry market growth.
that makes a lot of sense, though.
Yeah.
For a big purchase, you're buying the story, the trust, the status that comes with a known brand.
And the financial leverage here is enormous. The sources say branded items can sell for around 6 times the price of a comparable unbranded piece.
6 times. Okay, that fundamentally changes the profit picture for brands that get it right.
It absolutely does. Massive potential for higher margins. But it also means way more competition.
Right.
You've got the established luxury houses, fashion brands moving into jewelry, new direct-to-consumer startups, all chasing customers who want that brand identity. Michael Burke from Louis Vuitton even called fine jewelry one of their highest growth categories.
So from a financial accounting view, companies need to be tracking revenue super carefully branded versus unbranded to see where the profit's really coming from. And building that brand, that costs serious money. Marketing, advertising, fancy stores, that all hits the profit and loss statement.
Right, and the brand itself becomes this really valuable, intangible asset on the balance sheet, which needs careful valuation, reporting. It's complex.
So huge investment in branding and accounting has to capture the value and the return on that. Okay, Third key shift for jewelry.
This one's the sustainability surge. It's moved from being, a nice to have to a major factor. Sustainability is expected to influence maybe 20 to 30% of global jewelry sales by 2025.
And this must be particularly critical for materials like gold, diamonds, gemstones, where the supply chains can be complicated.
Extremely relevant. And the motivation isn't just avoiding bad PR anymore. It's becoming a strategic must-do to win over consumers, especially younger ones.
They care more about where things come from.
They really do. Lelio Gavaca from Bulgari says younger consumers focus much more on corporate social responsibility.
And if you want to be credible on sustainability, you need transparency.
That's the absolute key takeaway from the sources here. Brands need way more traceability. You need to be able to track materials right from the source, the mine, the recycler, through every step, cutting, polishing, setting, to the final piece.
So not just marketing fluff, you need to prove it.
Exactly. Trace the entire journey.
This is where supply chain gets directly impacted by consumer demand and increasingly regulations. Building that traceability means big investments, tracking systems, maybe blockchain, auditing suppliers constantly, working with certified ethical sources, which might cost more.
It's a fundamental change in how you source and operate. And financially, yes, it impacts the cost of goods sold. Ethical materials can be pricier.
Okay.
You've got the investment in the traceability systems, the auditing costs, and now with new sustainability reporting rules coming in.
More reporting requirements.
Yeah, another layer of compliance. You have to track and report these non-financial metrics alongside the financials because ESG factors, environmental, social governance, increasingly affect brand value and financial risk.
So sustainability is becoming a core part of supply chain management and financial reporting.
Absolutely integral. Okay, let's pivot to watches. The premium ultra luxury end, slightly slower overall growth predicted here, remember? That 1 to 3% a year.
Right, compared to branded jewelry.
But it's facing equally huge shifts.
What's the first big one for watches?
The DTC shakeup. That move to direct-to-consumer sales is accelerating fast.
So cutting out the middleman, the traditional retailers.
Largely, yeah. For decades, those multi-brand stores own the customer relationship. Now, watch brands want that relationship themselves. They want more control over the experience, and let's be blunt, they want that retailer margin.
So they're opening their own boutiques, boosting their own website.
Exactly, and the shift is significant. The sources estimate around $2.4 billion in annual revenue will move from those traditional retailers directly to the brands by 2025.
Wow, that's a serious chunk of change swapping channels.
It completely redraws the distribution map, the supply chain.
Yeah.
Instead of shipping cases of watches to a few hundred retailers, brands are now managing inventory, fulfillment, shipping for potentially millions of individual customer orders globally. It's a whole different operational beast.
And there's that quote from Thomas Bayode pointing out that these brands, they haven't historically been consumer-facing.
Yeah.
They need new skills.
That's the crux of it. They need massive investment, not just in stores and websites, but in customer service teams, training their own staff, becoming experts in online engagement, fulfillment stuff their retail partners used to handle.
And the financial side changes dramatically, too.
Completely. Revenue recognition shifts. Instead of booking big wholesale orders when retailers get stock, you book smaller individual sales when the customer actually buys the watch.
Right.
Brands get the retail margin, yes, but now they absorb all the costs. Rent, staff, e-commerce fees, shipping, returns. It changes their whole cost structure, their margins, how they manage working capital because they hold inventory longer.
Okay, that leads nicely into the second watch shift, the pre-owned market. That's exploded, hasn't it?
Oh, big time. It's forecast to be the absolute fastest growing segment in the industry, expected to hit $29, maybe $32 billion in sales by 2025.
Wait, that's almost as big as the entire branded fine jewelry market we just talked about?
Puts it in perspective, right? Huge scale. It's driven by collectors, younger buyers maybe getting their first luxury watch, cost-conscious shoppers, all feeling more confident using online platforms that guarantee authenticity.
And brands want a piece of that action.
Yeah.
The double dipping idea.
Many do, yeah. Earn on the first sale, then maybe earn again facilitating or participating in the resale. It keeps the brand ecosystem strong.
And Deloitte breaks down those different models, 1P, 2P, 3P, for how platforms or brands get involved.
Right, and they have very different implications. 1P means the platform buys the watch, owns it, refurbishes it, resells it, needs lots of capital, carries inventory risks.
So if the market drops, they lose out.
Exactly. 2P is consignment. They help the owner sell it, take a commission. Less capital risk, but still need to handle authentication, logistics. 3Ps is just a marketplace connecting buyers and sellers, taking a transaction fee, minimal risk for the platform, but less control.
So a brand stepping into pre-owned has huge strategic choices.
Right.
Which model? That then dictates their supply chain for checking watches, fixing them up, shipping them.
And completely changes the financial accounting. How do you value pre-owned inventory? Is revenue the full sale price or just a commission? How do you account for the risk?
Yeah, lots to figure out.
And Michelle Sophisti notes it can be great for showcasing brand heritage. Deloitte's data backs it up, too. Likelihood of buying pre-owned doubled from 2020 to 2024. And a good chunk of people, 22%, are willing to spend serious money, like $1,700 up to $17,000 on pre-owned.
That's a strong market signal. Okay, third shift for watches.
This one's tough. The mid-market squeeze. Brands in that middle tier are feeling pressure from both sides.
How so?
At the lower end, you've got smartwatches stealing wrist space, cool new digital brands, fashion watches. Then at the higher end, aspirational buyers are skipping the middle and trading up directly to the big luxury names.
Ouch. So they're losing out to cheaper options and more expensive ones.
Pretty much. The financial risk is real. These brands could miss out on $2.5 billion in revenue by 2025 if they don't adapt. Silas Walton mentions how low barriers online help the entry-level brands, adding pressure.
So they really need to kind of revitalize themselves. New products, better stories.
Exactly, which means, again, financial investment. Spending on R&D for innovation, spending on marketing to build a compelling brand narrative.
And the accounting side needs to track if that spending is working. Is it stopping the revenue decline in that segment? What's the ROI?
Precisely. You need meticulous segment performance tracking.
Okay, let's broaden out slightly. What other operational or financial insights did the Deloitte reports highlight?
One area executives are really buzzing about for future growth is India.
Ah, yes. India seems to be on everyone's luxury radar.
It really does. The numbers are compelling. Swiss watch exports to India jumped over 18% in the first part of 2023. Deloitte predicts sales could top 400 million Swiss francs by 2028. India could easily be a top 10 export market within a decade, and consumers there love watches. 94% wear one, apparently, matched only by the UAE.
Okay, but entering or scaling up significantly in a market like India, that's a massive supply chain undertaking.
Huge. New distribution partners, logistics networks handling customs, local delivery, plus building a retail presence, owned stores, or partners.
And financially, you're forecasting for a new market, managing currency risk, understanding local taxes, tracking the return on that big upfront investment.
All of that. Major financial planning and tracking involved.
Now, despite all this digital transformation talk, the reports still stress the importance of the in-person experience, right? Especially for the really expensive stuff.
Absolutely. Something like 62% of brands still expect physical stores to dominate sales over the next 5 years. Consumers want to touch and feel the product. That's 52%. They value talking to knowledgeable staff face-to-face. 43%. That's why brands are still investing in expanding retail space, flagship stores, and why those big watch fairs remain crucial for business. 9 out of 10 execs say so.
So that physical footprint, it remains a big cost center. Rent, staff, security, managing inventory across loads of locations.
Definitely. And the supply chain has to optimize getting the right stock to the right store at the right time. A complex balancing act with online demand, too.
Right.
Financially, accounting needs to track profitability, channel by channel, physical versus online, managing those different costs. Deloitte also mentions social selling as important, especially in Asia. Kind of blurs the line, starts digital, ends in store sometimes. More tracking needed.
We covered sustainability for jewelry. Deloitte reinforces that for watches, too.
Yes, it's table stakes now. Over 2/3 of execs say it's part of corporate strategy. Investment areas are similar. Circularity, better governance, ethical gold, 86% importance, recycled materials, 76%, leather alternatives, 74%.
And those new reporting regulations forcing transparency.
Exactly. It's a compliance issue now, adding reporting complexity. It directly pushes supply chains to change sourcing and production.
Right.
Financially, it means investment costs, maybe higher material costs, reporting costs. But there's an upside. Data shows 34% of consumers would pick a sustainable brand over just an image-focused one. So it can drive sales and brand value, especially with younger groups.
Okay, looking at the wider economy, how are executives feeling? A bit more cautious.
Seems so, yeah. Less optimistic than maybe a year ago. Top risks. Geopolitical uncertainty is huge. 84% mention it, followed by inflation and cost of living pressures, 69%.
Understandable.
And operationally, a big worry for suppliers is the shortage of skilled workers, especially watchmakers in Switzerland. That limits their ability to ramp up production.
These risks directly hit financial forecasts and operational plans.
Yeah.
Geopolitics or staff shortages disrupt supply chains. Inflation pushes up costs, materials, labor.
Right, all feeding into the financial models and risk management.
One last quick point, AI. Any mention?
Brief mention, yeah. About half of execs plan to use generative AI for content creation, maybe a quarter for marketing and creative stuff.
So not core supply chain or finance yet, but could impact efficiency, costs, staffing down the line.
Exactly. Something to watch for future impact on operations and financial performance.
Wow, okay, so what a fascinating picture. You've got these industries steeped in tradition, now scrambling with digital speed, the power of branding, this huge demand for sustainability and knowing where things come from. Plus major disruptions in how products even reach people, with DTC and pre-owned booming, while the middle market gets squeezed.
Yeah, these aren't small adjustments. They're fundamental shifts changing entire business models. They demand huge changes all the way through the supply chain from mind to wrist, and they're totally reshaping the financial side. New investments, new revenue models, way more reporting.
And while there are definitely challenges, risks clearly laid out in these sources, there are also big opportunities, right, for those companies that can actually adapt and innovate through all this.
Absolutely. The core value, craftsmanship, heritage that's still there, but now it has to coexist with digital savvy and proven ethical practices.
Which kind of leaves us with a final thought for you, the listener, to chew on after this deep dive. As these luxury industries try to blend their incredible history with digital tech and these growing demands for transparency, how much will the value we place on a luxury watch or a piece of fine jewelry ultimately depend on just its craftsmanship and story, versus the integrity and the visibility of its entire journey, from the absolute source of its materials all the way to ending up on your wrist or neck?
As you can see, this was a financial accounting focus, and it's more so along the lines of supply chain volatility and what effects has that on financial accounting. Hope you enjoyed this episode. This is Denny Lanes. I have not been your host today. Thanks for listening. Appreciate your time. Bye.